Ladies and gentlemen, stop what you're doing. Something just happened in the banking system that should make every single person paying attention sit up and take notice. 32 banks, not one, not five. 32 major financial institutions just moved in coordinated formation to build what they're calling an emergency liquidity shield. Now, if you're hearing this and thinking it's just another regulatory formality, another boring compliance exercise, I need you to understand something right now. Banks don't build emergency shields when everything is fine. They build them when they see something coming. The official story is simple, clean, almost boring. The Federal Reserve announced that 32 banks have collectively committed to a new emergency funding facility. It's being called a liquidity backstop mechanism. The numbers they're throwing around are enormous. And we're talking about a combined commitment of over $200 billion in emergency standby credit. $200 billion. That's not pocket change. That's not a precautionary measure you take because you're bored on a Tuesday afternoon. That's the kind of number you commit when you've run the stress tests, when you've seen the models, when you know what's sitting on the other side of the calendar. Here's what they want you to believe. They want you to think this is responsible banking, proactive risk management. They'll use words like prudent and forward thinking. They'll tell you this is exactly what regulators have been asking for since the last crisis. More coordination, more backup systems, more safety nets. And on the surface, that sounds reasonable. It sounds like grown-ups in a room making smart decisions. But I want you to think about something. When was the last time 32 competing banks agreed on anything? When was the last time institutions that spend every single day trying to outmaneuver each other suddenly held hands and said, yes, let's all commit hundreds of billions to the same emergency fund at the same time? This doesn't happen in a vacuum. This happens when someone sees the pressure building and when the models start flashing red, when the overnight lending markets start showing cracks that aren't supposed to be there yet. Because here's what most people don't understand about banking. Banks don't operate on certainty. They operate on confidence. The entire system runs on the belief that tomorrow will look like today, that liquidity will be there when you need it, that the markets will open, that the funding will roll over. The moment that confidence breaks, the moment someone blinks, the entire machine seizes up. And what we're seeing right now with 32 banks moving in unison is not confidence. This is preparation. Let me walk you through what this actually means. When banks commit to an emergency liquidity facility, they're essentially creating a private safety net. Think of it as a lifeboat fund. If one bank suddenly finds itself in a liquidity crisis, unable to meet its obligations, unable to fund its positions, the other banks in the consortium can step in and provide emergency cash. In theory, this prevents a single bank failure from becoming a systemic meltdown. In theory, this keeps the contagion from spreading. But here's the problem. You don't build a lifeboat when the ocean is calm. You build it when you see the storm forming on the horizon. And right now, 32 captains just looked at the same weather report. Now let's talk about timing. This announcement didn't come out of nowhere. In the last 6 weeks, we've seen some very specific developments in the financial system that don't make the front page, but matter enormously to the people running these institutions. We've seen repo market rates spike 3 times in the last month. Not massive spikes, not panic spikes, but enough to raise eyebrows, enough to make the overnight funding desks start making phone calls. We've seen the Fed quietly increase its reverse repo operations. We've seen Treasury yields do things they're not supposed to do, inversions that held longer than expected. Credit spreads widening in corners of the market that usually stay quiet. And here's the part that should concern you. We've seen deposit flight, not from retail customers, not from everyday people moving their checking accounts. We're talking about institutional money, corporate treasuries, wealth management accounts, the kind of money that moves in $50 million blocks. That money has been leaving certain banks, quietly, steadily, not enough to trigger headlines, not enough to cause panic, but enough that the banks holding those deposits started doing the math, started asking themselves, what happens if this accelerates? What happens if the trickle becomes a flood? What happens if we wake up one morning and the money that was supposed to be there isn't there? This is where the emergency shield comes in. Because if you're a bank and you see your deposit base starting to erode, you have 2 choices. You can either liquidate assets to cover the outflows, which means selling into a market that might not want to buy, taking losses, triggering more concern, or you can tap an emergency facility, borrow against your assets, keep the lights on, keep the confidence alive. And if 32 banks just agreed to create that facility together, it means 32 banks just looked at their balance sheets and decided they might need it. Now here's what makes this particularly interesting. This isn't a government program. This isn't the Fed stepping in with a new facility. This is the banks doing it themselves. And that tells you something critical. It tells you they don't want to wait for the government. They don't want to wait for the Fed to design a program, get approval, navigate the politics. They want something they control, something they can activate immediately. something that doesn't require congressional hearings or press conferences or explanations. Because when you need emergency liquidity, you need it now, not next week, not after the regulators have their meeting, now. Let me give you some context about what happened the last time we saw coordination like this. It was early 2008, before Lehman, before the headlines. A group of major banks quietly created a similar facility. They called it the Super SIV. The idea was to provide a backstop for structured investment vehicles that were starting to wobble. The banks committed billions. They announced it with confidence. They said it showed strength. And within 6 months, the entire financial system was in free fall. Now, I'm not saying we're in 2008. I'm not saying Lehman is about to happen again. But I am saying that when banks move with this kind of coordination, when they commit this kind of capital to an emergency facility, they hope they never have to use. They're not doing it because everything is fine. They're doing it because they've seen the scenarios. They've run the numbers, and they don't like what they see. Here's another piece of the puzzle. 3 of the banks in this consortium are institutions that publicly stated just 2 months ago that their liquidity positions were strong, that they had no concerns about deposit stability, that they were well capitalized and well positioned for any economic scenario. And now those same banks are committing tens of billions to an emergency shield. So either they were lying 2 months ago, or something changed fast enough and significantly enough that their entire risk posture shifted. And if you're sitting there thinking that's normal, that banks just casually change their emergency planning on a whim, you're not paying attention. Let's talk about what this facility actually does in practice. When a bank needs to tap this shield, they pledge collateral, usually high-quality assets, treasuries, agency bonds, maybe some investment-grade corporate debt. In exchange, they get cash, immediate liquidity. The terms are typically punitive, higher interest rates than normal funding markets, haircuts on the collateral. It's designed to be expensive. It's designed to be a last resort. Because if it's cheap, if it's easy, banks would use it all the time, and the whole system becomes dependent on emergency funding. So the fact that 32 banks just agreed to create this facility, knowing it's expensive, knowing it's punitive, tells you they think there's a real scenario where paying those costs is better than the alternative. And what's the alternative? The alternative is what happened to Silicon Valley Bank, what happened to Signature, what happened to First Republic. The alternative is waking up one morning and realizing that the uninsured deposits are gone, that the funding markets won't roll over your short-term debt, that your asset values are underwater, that you have hours, not days, to find a solution. And in that scenario, there is no solution. There's only a phone call to the regulators. There's only a weekend takeover. There's only a press release on Sunday night explaining to the world that another bank just failed. So these 32 banks looked at that scenario and said, we need insurance. We need a way out that doesn't involve the FDIC, that doesn't involve emergency Fed lending, that doesn't involve our names in the headlines next to the word failure. And they built it themselves. They created their own private safety net. Which brings up an interesting question. If this facility exists, if it's fully funded, if it's ready to deploy, who uses it first? Which bank in this consortium is sitting there right now, looking at their books and thinking, we might actually need this? Because someone built this for a reason. Someone ran the numbers and decided the risk was real enough to commit billions, and that someone is inside this group of 32. Now let's zoom out. If 32 major banks just created an emergency shield, they collectively believe multiple institutions could face liquidity stress simultaneously. Not one isolated failure. Multiple banks. Simultaneous pressure. You build a facility this size when you think the stress could spread faster than regulators can respond. And here's where it gets really uncomfortable. These banks have access to data you and I will never see. They have real-time feeds on deposit flows, on credit exposure, on counterparty risk, on derivative positions. They have risk models that cost tens of millions of dollars to build and run continuously. And all of that data, all of those models, all of that information just told 32 different management teams the same thing. It told them to build a shield right now, not next quarter, not next year, now. Think about the mechanics of how this comes together. Someone had to make the first call. Some CEO or CFO had to pick up the phone and say to their counterpart at another bank, we need to talk about emergency liquidity. And that person on the other end had to immediately understand, had to immediately agree, had to immediately say, yes, we've been thinking the same thing. And then they called another bank and another. And within weeks, you have 32 institutions aligned, 32 legal teams drafting agreements, 32 boards approving commitments. That doesn't happen unless the threat is real. That doesn't happen unless everyone in those rooms looked at the same risk and came to the same conclusion. So what's the risk? What are they seeing that we're not? My assessment, based on the pattern of moves in the last 90 days, is that they're worried about a funding crisis, not a credit crisis, not a wave of defaults, a funding crisis, the kind where liquid, Good assets become illiquid because there's no bid, where treasury markets seize up, where overnight lending rates spike, where the assumption that you can always sell something quickly at a fair price suddenly breaks. Because that's the scenario where banks fail fast. That's the scenario where you go from solvent to insolvent in a single trading session. And that's the scenario where having an emergency liquidity facility might be the difference between surviving and becoming a headline. Here's what I'm watching now. I'm watching to see if any of these 32 banks show up in the Fed's discount window reports. Because if they start tapping the discount window while simultaneously having access to this private facility, that tells you the pressure is real. That tells you they're using every tool available. I'm watching deposit data. If institutional deposits continue to migrate away from these banks, it confirms the concern was justified. I'm watching the repo markets. If overnight rates stay elevated, if the volatility continues, it means the funding stress isn't going away. And most importantly, I'm watching to see if this group of 32 expands. Because if more banks want in, if this consortium grows, it means the risk they identified is spreading. The official narrative will continue to be that this is responsible risk management, that this is banks learning from past mistakes, that this is coordination and cooperation in action. And maybe that's true. Maybe this facility never gets used. Maybe it sits there as a deterrent, as insurance that never pays out. But you don't commit $200 billion to insurance you don't think you'll need. You don't coordinate 32 institutions to build something you're not planning to use. And you don't do it right now, in this specific moment, unless the models are telling you something urgent, something that required action this quarter, this month, this week. So when you see the headlines about banks strengthening their liquidity positions, about improved coordination, about enhanced safety mechanisms, understand what you're actually reading. You're reading about institutions that just looked at the next 6 to 12 months and decided they needed a backup plan. Not because they're pessimistic, not because they're fearful, but because they have information, they have data, they have insight to stresses that haven't made the news yet. And that information was compelling enough to move 32 different organizations into coordinated action. The trap has been built, the shield is up, the emergency facility is live, and now we wait to see which bank reaches for it first. Because someone will. That's why it exists. And when that first call gets made, when that first institution taps this facility, you won't hear about it in real time. You'll hear about it later, maybe in a quarterly filing, maybe in a regulatory report. Maybe never, but it will happen. Because banks don't build lifeboats they don't plan to use. They build them because they've already seen the water rising. Stay alert.